Welcome to the video newsletter for clients of Index Gurus Wealth Management. Hello, this is Farouk Jaffer, Certified Financial Planning Professional and Head of Index Gurus Wealth Management. Over the past 3 months, the stock market has experienced significant volatility due to concerns over inflation. Rising inflationary pressures, fueled by supply chain disruptions, labor shortages, and increased consumer demand, led to fears of tighter monetary policy and higher interest rates, impacting investor sentiment. Markets have digested the Fed's 2023 actions with ease, as major indexes find themselves recovering well, led by hype in technology and artificial intelligence. Going forward, it seems unlikely that a couple more quarter-point rate hikes could derail this rally, considering how far we've come. If the Fed decides to pause interest rates, historically both domestic equity and fixed income markets have posted higher returns 3 months after the Fed's last rate hike. This is a likely scenario since policy rates are consistent with the Fed's guidance and that bank stress has tightened financial conditions. With unemployment rates at all-time lows, demand for big-ticket items has strengthened, and that is the latest sign of resilience in the U.S. economy. Wall Street analysts have been marking up their expectations for the profits that S&P 500 companies are likely to generate over the next year. When we look at a broad picture of growth, a weak indicator is revealed by the index that shows a downward trend in the U.S. manufacturing and services industry. Ironically, this may be good for stocks if it contributes to a longer Fed pause. There are a number of factors that could weigh on stock prices, including rising inflation, the war in Ukraine, and China's economic slowdown. However, there are also some potential positive catalysts such as energy prices, artificial intelligence, healthcare, and demand for defense products. The technology sector is expected to maintain its upward trajectory as companies leverage advancements in artificial intelligence and cloud computing. Global spending on AI-centric systems will increase 27% this year to reach $154 billion, according to the International Data Corporation. The energy sector will witness continued growth in renewable energy sources such as solar and wind, driven by increasing environmental concerns and government support. According to the International Renewable Energy Agency, renewable energy capacity is expected to double in the next few years, which highlights the sector's promising growth potential. Defense stocks could also perform well, as the war in Ukraine is increasing demand for defense products. The U.S. is the world's largest defense spender, accounting for 39% of global defense spending in 2022. The U.S. Department of Defense is expected to increase spending by over 4% from 2022. Healthcare stocks will benefit from ongoing advancements in biotechnology and personalized medicine. Did you know that the global telehealth market is estimated to double by 2026, reflecting the increased adoption of remote healthcare services? With new technology comes the responsibility of privacy and cybersecurity. We are seeing increased demand in this area. In fact, Gartner predicts that global spending on security and risk management will grow by more than 11% in 2023. The underlying fundamentals of a company are responsible for the lion's share of stock returns. As a result, Index Gurus advocates companies with solid balance sheets and positive free cash flow. Other important characteristics are companies that grow their dividends while harnessing the latest innovations and megatrends, which will be addressed later in this video. Fed actions historically affect the economy with long and variable lags, so the economic consequences are yet to be fully felt, like the risk of a recession. That said, experts believe any recession could be relatively shallow in depth and duration. The key reason is that consumers account for nearly 70% of U.S. GDP, which remains in good shape without a heavy debt burden like in 2008. What if we enter a recession? It is possible that this may occur, but keep in mind that the average recession lasts 13.3 months, while the average expansion lasts 60.3 months. Based on the acceleration across goods and services inflation, we can see a huge improvement from the first half of this year. It looks like the Fed has had a positive impact on inflation. Big down days are tough, but staying invested is crucial. Since 1980, there have been 51 days during which the S&P 500 dropped more than 4% in a single session like it did recently, where 9 of those days happened during 2020. After each instance, the market never failed to recover and make new highs. Growth, driven by consumers and corporations, has held up admirably through the current headwinds. We believe long-term investors will be rewarded for enduring the volatility that will likely define markets over the remainder of the year. The next time market volatility feels scary enough to make you second-guess your long-term investment strategy, have a good think before you get out of the market. There could be a 70% chance you'll miss one of the best days. The chart below illustrates what has happened when an investor missed the 10 single best days in markets over the past 20 years. Given our societal changes, it makes sense to tilt a diversified portfolio in various sectors. Why not just put it all in an IT or a QQQ? You'll notice that IT, the orange color, has held the top spots only in the past 4 years. Other top sectors include consumer discretionary in red and communication services light blue. This will change over time, so holding top companies in various sectors is important. It is so important to practice diversification, even though it sometimes feels painful and comes with FOMO, fear of missing out. Morningstar did a study comparing 2 portfolios over the past 20 years, comparing a growth portfolio to a diversified portfolio with 40% in income securities. As you can see, you would have actually come out ahead with a diversified portfolio. Focus on your goals and not the news. Index Gurus is going to make sure you are well positioned in great companies that will weather the coronavirus pandemic. With proper positioning and guidance, the chances that you will be in the green, in the positive after 1 year are 75% in your favor. The US has shown that they are willing to keep the economy humming, so it makes sense to stay invested. Thank you in advance for your trust. You can count on Index Gurus to help you reach your goals with financial peace of mind.